So we continue our discussion of depreciation. So one is that if we purchase an asset midway through the year, that we wouldn't take a full year of depreciation. We would take what is a partial year of depreciation. So we're using the same example from all of our previous examples where we have a piece of equipment with a cost of 10,000, salvage value of 1,000, and useful life of 5 years. If we assume that we were purchased on October 1st, 2018, using straight line depreciation, we would only take 3 months of depreciation instead of an entire year. If you remember, our entire year was $1,800, but 3 months of depreciation is $450. We wouldn't be able to take the entire year for a machine purchased in October. Next, we'll talk about changes in estimates. So as we're using an asset, we might decide that we need to change our original estimates. Remember, depreciation, useful life, and salvage value are all estimates. So we might change our mind about the predicted useful life, or we might change our mind about the predicted salvage value. So we're going to look at the same example, except during the third year, we decided that we were going to have another 4 years. So instead of it being 5 years total, we were actually going to get 4 more years out of this machine instead of 2 more years. So, and that the salvage value would then be less because we were going to use it more. So we would change our depreciation expense with that information. Our current book value at the beginning of the third year is $6,400. We then decide that the salvage value is actually going to be $400 and that it's going to be good for another 4 years. So our new straight line depreciation expense is $1,500 per year. If we have impairment, this would be a permanent decline in the fair value of an asset, and we would write the asset down to its fair value. The impairment is just the journalizing that decline. So we would have an impairment loss against accumulated depreciation equipment. Then we're going to talk about the difference between revenue and capital expenditures. So as we have a piece of equipment or property, plant, and equipment in use, we are going to have to make repairs to it at some point. We have revenue expenditures and capital expenditures as types of repairs. So revenue expenditures are these ordinary maintenance. They don't increase the life or the capabilities of the asset. They are an expense in the current period and they're reported on the income statement. Capital expenditures, however, increase the life of the asset, and they are then recorded as an addition to that asset and reported on the balance sheet. So how do we decide what is revenue or capital? Well, revenue is just keeping this functioning. So if we look at a car, an ordinary repair expense are going to be things like oil change, rotating tires, replacing spark plugs, those kind of things. However, an extraordinary repair or capital repair would be if we put a new engine in it that then extended the life of that vehicle for several years. So the journal entries for those is that an ordinary repair gets recorded as repairs expense, where a capital expenditure gets recorded on the piece of equipment. Once we're done with an asset, we will sell it. We'll either discard it because it's no longer useful useful and we can't get any money for it, or we will sell it, or we can even exchange it. So when we want to dispose of a plant asset, first we update our depreciation to the date of disposal. Then we are going to create a journal. So if we are disposing of the equipment or selling it, we're going to remove the asset cost, remove accumulated depreciation. We're going to record if we received any cash or if we had to pay cash out for disposal. And then we're going to record a gain or a loss on disposal. If the cash we received is larger than the book value, we received a gain. If the cash we received is less than the book value, we record a loss. If the cash equals the book value, we have no gain or loss to record. So we're going to look at some examples of discarding of plant assets. So first we have a fully depreciated machine. So we have a machine cost $9,000. We have accumulated depreciation of $9,000. So we have a zero salvage value on this machine. We discard it. We were depreciating using the straight line method over 8 years and have a zero salvage value. So when we discard this piece of equipment, all we have to do is remove the accumulated depreciation and remove the machinery from our records. However, it's more common that we dispose of those before they're fully depreciated. So in this example, we have equipment costing $8,000 with accumulated depreciation of $6,000 was discarded on July 1st. We were using straight line depreciation over 8 years with a zero salvage value. The first thing that we have to do is bring our depreciation expense up to date. So the last time we would have recorded depreciation expense would have been our end of year adjusting entry on December 31st. So we need to record 6 months of depreciation on that piece of equipment. The next thing that we do is we discard of the asset. So we have to remove our accumulated depreciation from the book and remove our equipment from the book. Then we're going to record a loss because we didn't receive any money for this. We're just discarding it. We have a loss on disposal of $1,500. Our other options are to sell it. So we have a piece of equipment that originally cost $16,000, has accumulated depreciation of $12,000. We use straight line depreciation and we're selling this piece of equipment for $3,000. So first we have to update our depreciation to March 31st. So we need to record 3 months of depreciation. Then we need to record the sale of the asset at book value. So we receive cash, we remove our accumulated depreciation from the records, and we move our equipment from the records. If we sell that asset above book value, then we would also record a gain on the disposal of equipment. And if we record that asset below book value, we would record a loss on disposal of equipment. Now we're going to talk about natural resource assets. And instead of depreciating natural resources, the terminology is depletion. But the concept is very similar to depreciation. So we have our total cost charged to depletion expense over multiple periods. We extract stuff from a natural environment and we have an accumulated depletion account. Examples of natural resources are oil, coal, gold, anything that we take from the ground or from the earth. So in this example, we have a mineral deposit with an estimated 250,000 tons of ore. We purchased it for $500,000 and we expect zero salvage value. We use the depletion per unit amount. So we're going to take cost minus salvage value divided by our total units of capacity. Then each year when we record our depletion expense, it is times the units extracted and sold in that period. So we would have our depletion expense in the first year of $170,000 and accumulated depletion of $170,000. We would show on the balance sheet that we have an asset of a mineral deposit and any accumulated depletion recorded against that mineral deposit. If we have depletion expense and we still have unsold ore, we need to record inventory for that ore. So in the first example, we had sold everything that we took out. In this example, we didn't sell everything, and so we have some ore still in our inventory, and we would need to record that inventory in our records.